Chapter 6: Professional Accounting in the Public Interest. In this chapter, we will be discussing the public expectations for the role of the professional accountant and the principles that should be observed to ensure appropriate behavior. More specifically, we will discuss the public's view on the accounting profession, the fiduciary relationship between the professional accountant and his or her client, the duty of loyalty the professional accountant has to different parties, the values that a professional accountant is expected to adhere to, how a professional accountant can go about developing the appropriate judgment and values, sources of ethical guidance, professional codes of conduct, and how to handle conflicts of interest. The public's expectations for a particular profession will govern the rights the profession enjoys. For example, the public holds much higher expectations for public accountants than for non-professionals such as sales or personnel managers. These expectations are different because professional accountants provide real, significant value with their services, and it is imperative that clients trust them. Highly respected professionals are provided with autonomy. That is, they may be judged by one's peers rather than government officials. This autonomy allows a profession to manage its affairs efficiently and discreetly so that the public believes the profession is responsible and able to discharge its duties to members of the public properly. However, if the public believes the credibility of the professionals has weakened, then the government may step in. For example, in the past, the auditing profession in the United States was self-regulated through peer reviews. Following the Sarbanes-Oxley Act of 2002, self-regulation was replaced by independent inspections conducted by the Public Company Accounting Oversight Board. Professionals such as accountants have a fiduciary relationship with their clients. A fiduciary relationship is one where the services provided are extremely important to the client and where there is a significant difference in the level of expertise between the professional and the client, such that the client must trust on the expertise and judgment of the professional. Because of the amount of trust required in a fiduciary relationship, professionals should develop a set of values to guide their members and require that each professional possess personal values that coincide with the values expected of the profession. For example, values that one may expect of a professional accountant may include honesty, integrity, objectivity, discretion, the courage to pursue convictions, and strength to resist temptation. These values can apply to any profession. Without these values, the necessary trust required to support the fiduciary relationship cannot be maintained. A professional accountant's loyalty is owed first to the public and then to the accounting profession. In the case of auditors, their loyalty should be to the public first, and next to the existing shareholders, followed by the accounting profession, the audit firm, and finally to management of the organization. In the case of accountants employed by organizations or by audit firms, there is no statutory or contractual duty to shareholders or the public. Nevertheless, these accountants are still expected to exercise the values of honesty, integrity, and due care. The main duty of professional accountants is to ensure the accuracy and reliability of their work for the benefit of the end user, the public. A professional accountant is expected to be both an accountant and a professional. That is, they should have the technical expertise and they should also adhere to the professional expectations, values, and standards set by the professional body to which they belong. In situations of uncertainty, accountants must make sure that their decisions are not affected by a failure to observe proper ethical values. Ethical values are just as important as technical competence, if not more, because if a professional finds a problem that exceeds his or her technical competence, then hopefully the professional's ethical values will compel the professional to recognize and disclose that fact to the client. Without ethical values, the trust necessary for a fiduciary relationship cannot be sustained. The duty of the professional accountant is to the public, but frequently decisions have differing impacts on different stakeholders. Professional accountants are given the right to provide fiduciary services to society because they agree to maintain the trust in a fiduciary relationship. Professional accountants are expected to apply their technical expertise with the following values: courage, honesty, integrity, objectivity, due care, professional skepticism, competence, confidentiality, and commitment to place the needs of the public, the client, the profession, and the employer or firm before the professional's own self-interest. The proper discharge of the ethical values of competence, integrity, honesty, and objectivity relies substantially, if not primarily, on the personal ethical values of the professional accountant involved. If the profession itself has high standards, the individual professional can choose to ignore them. Often, however, a professional is not sufficiently aware of potential ethical dilemmas or the appropriate values to properly discharge his or her duties. Additionally, a professional may be wrong in his or her judgment about the potential outcome of an ethical dilemma or about the seriousness of the outcome for those who must bear the impact. The credibility of the profession, therefore, rests on the values it espouses, the personal and professional ethical values of each individual member, and the quality of judgment exercised. How do professional accountants develop the judgment they must apply to ethical dilemmas? Traditionally, trial and error has been the established method. However, this method is costly for the accountant, the client, society, and the profession as a whole. The dangers of trial and error can be reduced through the implementation of a learning program that deals with the major issues to be faced and that suggests practical, ethical approaches to their resolution. There are several sources of ethical guidance available to professional accountants. A good starting point for ethical guidance are codes of conduct of the employer and the code of ethics of professional accounting bodies such as the AICPA's Code of Professional Conduct. A professional can also look to ethical guidance published by standard setters such as the PCAOB and FASB. Regulators such as the SEC and New York Stock Exchange also provide expectations on how professionals should behave. Professional codes of conduct are designed to provide guidance about conduct expected of members so that services offered will be of acceptable quality. To be effective, codes of conduct should blend fundamental principles with a limited number of specific rules. Otherwise, a code of conduct would be so voluminous that members would refuse to spend the time to actually read the codes of conduct. The fundamental principles and standards listed below are found in most codes. Let's look at the AICPA's Code of Professional Conduct. As you can see, the AICPA explains in their code that members should act in a way that will serve the public interest, honor the public interest, and demonstrate a commitment to professionalism. The code also explains exactly which parties are deemed to be clients. This includes credit grantors, governments, employers, investors, the business and financial community, and others who rely on the objectivity and integrity of the members of the AICPA. This next excerpt from the AICPA's Code of Professional Conduct explains the importance of acting with integrity. Integrity is a fundamental value to the profession. It is measured in terms of what is right and just. In the event that a professional accountant is faced with conflicting opinions, he should ask himself if he is doing what a person of integrity would do, and if he is retaining his integrity upon making his decision. Integrity also requires an AICPA member to observe the principles of objectivity, independence, and due care. The following excerpt explains the significance of acting objectively and being independent. According to the objectivity and independence principle, a member should maintain objectivity and be free of conflict of interest when performing his or her professional responsibilities. Objectivity is a state of mind and a distinguishing feature of the profession. The AICPA's Code of Professional Conduct also references the requirement to follow the due care principle. According to the AICPA, the quest for excellence is the essence of due care. Due care requires a member to perform his or her responsibilities with competence and diligence. Competence can be obtained with a combination of education and experience. Diligence requires members to render services promptly and carefully, to be thorough, and to observe applicable technical and ethical standards. Surprisingly, changes in professional codes tends to be cyclical. Roughly every decade, pressure comes on the accounting profession due to a financial or accounting scandal that has eroded the credibility of the profession. Pressures tend to be the greatest when the North American economy is weak, causing companies to engage in fraud. Professional codes have been revised to provide stronger guidance to avoid these problems. In the past, accountants have failed to see the importance of codes of ethics or were unable to interpret the general principles and rules laid out. Lately, there has been a renewed interest in ethics. For example, ethics education has become an official education requirement for professional accountants. Some states even require that the ethics course is taken prior to attempting professional examination. Also, it has become customary for codes to encourage accountants to seek counsel on ethical issues. Professional accountants may, at some point in their career, deal with a conflict of interest situation. A conflict of interest is any influence, interest, or relationship that could cause a professional accountant's judgment to deviate from applying the professional standards to client matters. A professional accountant's view of conflict of interest situations is different to that of a director or executive because the professional accountant is a fiduciary to the public. Therefore, the public accountant is expected to meet the needs of the client, but not at the cost of the public interest. A professional accountant should not go to absolutely any lengths to serve a specific client's interest, unless the public interest is also served. Professional accountants must always be on the alert for potential conflict of interest problems because these problems have the potential to erode independence. The AICPA lists 7 categories of threats or conflicts that could sway the professional accountants from acting in the public interest. They are as follows: adverse interest, self-interest, review of one's own work, management participation, advocating a familiarity with the management, directors, or owners of the client corporation, and intimidation or undue influence by management, directors, or owners. If a professional accountant identifies potential conflict of interest situations, he or she should attempt to avoid the conflict, eliminate it, or reduce the risk by applying safeguards. The AICPA provides examples of safeguards that can be implemented by a client or a firm. In addition, the AICPA provides the following list that can be found in techniques and approaches detailed in professional guidelines, legislation, and regulations. The recent financial and management debacles have confirmed that professional accountants owe their primary loyalty to the public, not to their clients, management, or themselves. Professional accountants should properly understand their roles as fiduciaries. Otherwise, they cannot consistently behave in an ethically responsible way, and as a result, they may offer questionable advice and make decisions that can expose them to criticisms and negatively impact the accounting profession. The professional accountant must develop judgment, values, and character traits that embrace the public's expectations. Codes of ethics and conduct are continually refined to better guide professional accountants and ensure that unrestrained self-interest, bias, and misunderstanding do not cloud the professional's independent state of mind or give rise to an appearance that independence may be lacking.